Okay, so we're going to talk about cash flow and risk. And this starts getting us into some of the elements around um, taking all of the components from Chapter 4, which is time value money, and the capital budgeting pieces. And we're going to start looking at full size projects and how the decisions are made. So, a few things on cash flow and cash flow estimation. The most important and difficult step of an analysis of capital project is forecasting future cash flows. It's generally pretty easy to do the math. You might disagree with that statement, but when it comes down to getting the math done, when you look at the Excel tutorials and you kind of work through the math a few times, that becomes pretty rote. The big challenge for you as a finance person or even as a manager is trying to make sure you've got a good estimate for cash flow. And so your finance staff, your FP&A, financial planning and analysis staff, will generally work to coordinate other department efforts to pull all the information together, ensure that everybody is using the same set of assumptions. So general economic assumptions as far as business growth or what the general market conditions are going to be, and make sure that there's no bias in the forecast. So really try and work through and work out any bias that people have utilized in their forecast so that it becomes a real apples to apples comparison and the most accurate forecast possible. So there's a couple things that are absolutely critical for you to understand, particularly if you're coming from an accounting background. The first one is finance focuses on cash flow, not on accounting profit. And so we may see elements where you're like, well, you forgot about this non-cash expense, or you forgot about depreciation, or you forgot about amortization, or why are you factoring in taxes? Why are you looking at a cost that I could that I could accrue and spread out over a period of time? And in finance, we're worried about the actual cash in the bank and out of the bank and the timing of that cash flow. So we only evaluate after-tax cash flows because if you have to pay taxes, you're going to need to factor that in. And we only evaluate cash flows themselves. We don't evaluate kind of ephemeral things around, accruals or deferred costs or compensation. And we only look at incremental cash flows. So we only look at the cash flows that change after the capital budgeting project is done. So if you've got a project and you've got a factory, for instance, and it's already doing $10 million a month, and you've got to determine whether to expand that factory or not, we're going to not utilize that existing $10 million. If you do or don't do the project, that $10 million is going to continue. Really, all we're looking at is the incremental cash flow or the cash flow change that occurs if you decide to undertake the project or not. So incremental cash flows, as I just described, is a change in the firm's net cash flow associated with purchasing an asset. So there's a few problems in determining incremental cash flows that we tend to fall into when we're doing financial analysis. And I want to point these out to you. These 5 areas are ones that we tend to forget or ignore or factor in when we shouldn't. So the first one is a sunk cost. So a sunk cost is a cash outlay that's already been incurred and won't be recovered or changed if the project is purchased. And so you've got a situation where you may have bought a building in the past, and you now have a decision to make whether to utilize that building for a restaurant or whether to utilize that building for a warehouse. Your purchase price of that building is a sunk cost. It's already happened, and so it doesn't get factored into your incremental cash flow. What would get factored into your incremental cash flow is the cost of modifications to that building and then any future cash flows that might be impacted. And then you've got opportunity costs. So opportunity cost in that same scenario is the return on the best alternative use of the asset. So sometimes we forget about this. So we say, well, I can utilize this building for either a restaurant or a warehouse. Well, maybe the best opportunity for that building is to sell it and redeploy those assets elsewhere. And so one of the challenges when determining incremental cash flows is understanding kind of the universe of opportunity costs and making sure that they're factored in. Externalities are the effect that purchasing a project has on the cash flows in other parts of the firm. You have to factor in externalities. So if you've been utilizing this building, part of this building as a warehouse, and you decide to convert it completely over to a restaurant, you may have you may need to consider what you're going to or where you're going to store the things that were formerly in the portion of that building used as a warehouse and factor in the incremental rent associated with renting an additional warehouse or building an additional warehouse because you've repurposed that space. So an externality is a cost that might not be directly attributable to that project when you look at that project in a narrow box, but does potentially impact the firm outside of that box. Other externalities could be things like taxes, where there's tax benefits accrue or it changes your marginal tax rate, and those are going to be externalities that need to be factored in as well. You've got shipping and installation costs. So generally, don't forget that when you buy a piece of equipment, for instance, or when you buy inventory, you may have shipping costs associated with that inventory. You may have taxes associated with that inventory. You may have costs to install equipment in order to get it ready for use. Those all need to be factored in. So if you buy a material handling system, you may be able to spend $1 million for the material handling system, but it may cost you an extra $500,000 to get it installed. You need to factor in that $500,000 into your costs. And then inflation. Over time, the cost of labor, the cost of materials tends to increase. And so don't forget those increases in incremental cash flow as you go out over a period of years. It might not be very high today. Inflation runs 2 to 3% today, so it might not be very high today, but over a period of time, when you look at compounding, and we looked at compounding a little bit in Chapter 4, when you look at compounding and you get out 5 or 6 years, that could be a 20 to 25% difference in the cost of labor or raw materials over a 5 to 6 year period with just 3 to 4% inflation. So make sure that you factor inflation in as well. There's a way to identify incremental cash flows for a project, and the first one is look at the initial investment outlay, which is the incremental cash flow that occurs only at the beginning of the product's life. And there's really going to be three predominant cash flow streams. You've got your initial cash outlay, you've got your operating cash, and then you've got your terminal cash outlay. We'll talk through each one of those. Your initial investment outlay will include things like the purchase price of equipment or buildings or whatever else you need to buy, shipping and installation, the tax effect of selling an old asset. So if you have a replacement decision, let's say you're buying a new truck and you're going to sell the old truck, you have to figure out what tax impacts that's going to have, because the tax effect of that transaction is going to impact your cash flow. And then changes in investment in working capital. So if you need to set aside, for instance, an additional amount of money to buy additional inventory or to account for cash requirements related to collection of accounts receivable, and that causes you to set cash aside so that you've got a little bit in reserve, you need to factor that in, because that's cash that's no longer available and you're going to need to actually set it aside. So these four elements tend to be the biggest on initial cash flow. For operating cash flows, these are the cash flows that are essentially measured during the operational life of the project. And there's three predominant ones to start, and then we've got a few others that these are the obvious ones, and then there's a few others which are a little less obvious. So the first one is change in net sales. So if you're going to have sales go up or go down, you need to factor in that change in net sales. And sometimes these decisions could be discontinuing a line or moving off to some other project or product and replacing something. So you may have a net change in sales, which is negative or positive. You've got changes in salaries and other operating expenses to incur the project, and changes in taxes. And then at the end, you've got your terminal cash flows. So once you get to the end of a project, and let's say you've had an assembly line, and that assembly line has been building Beanie Babies for the last 10 years, and you've made a decision to replace that assembly line to produce Cabbage Patch Kids, you're going to have terminal cash flows associated with the discontinuance of the Beanie Baby project. And those terminal cash flows are associated with the project that occur only at the end of the project's life when the firm disposes of the project. So that could be salvage value or sale of the business or sale of the product line. That's going to include the tax effect of salvaging that asset. So you may have a profit or a loss associated with a sale or salvaging of that asset. And so you're going to need to be able to factor in that tax, either shield or expense. Change in net working capital. So if you had to set $100,000 aside to deal with additional accounts receivable, collections, and inventory, once you've discontinued, that money's going to come flowing back into the firm, so you get to collect that back essentially. And then you've got lost opportunity to salvage a replaced asset, so a replacement decision. So if you had an asset and you make a decision not to replace it, you may have a lost opportunity there, which would count as an expense. The formulaic way that we look at supplemental operating cash flow is your cash revenues. So increasing cash revenues or decreasing cash revenues. This is a delta, and you may hear me say the delta in, and that's change. So the delta in cash revenues minus the delta in cash expenses minus the delta in taxes. So essentially the change in cash revenues, a change in expenses, and a change in taxes will give you your net operating income. So here's your net or your supplemental operating cash flow. And if you think about it from an accounting perspective, it's easiest to think about it this way. Start with your net operating income, which is cash revenues minus cash expenses, and then you've got your depreciation, right? So depreciation is a non-cash expense. So if you're looking at it from an accounting perspective, it's a non-cash expense. So take your net operating income, multiply that by the tax rate, 1 minus the tax rate, because you're going to have to, that's the amount of cash you're going to be able to retain there, plus your depreciation, because this is a non-cash expense. Depreciation provides a cash shield. So if you have your net operating income plus your depreciation times 1 minus the tax rate plus tax rate times the depreciation, the change in depreciation, will give you your net operating cash flow or your supplemental operating cash flow. So again, taking a step back and walking, kind of set this formula aside and let's talk through it from a practical perspective. Your net operating income is your revenue minus expenses. In this case, we're looking at the change in net operating income. Think of it from an accounting perspective. So you've got your revenues minus expenses will give you your change in revenues minus change in expenses gives you your change in net operating income. Part of your expenses is normally depreciation expense. And so you get to add the depreciation expense back in because it's non-cash. You didn't actually spend money on depreciation expense. You may have had at the beginning of the project a cash flow out associated with the purchase of a piece of equipment, but that was factored in as cash in period 0, and we'll see how this works. But the depreciation that you're taking for accounting purposes gets added back in to your accounting operating income because it's non-cash expense. And then you're going to multiply that by 1 minus T. You get to keep that amount, essentially, the net operating profit, the change in net operating profit, less taxes. Then you're going to add back the tax shield, so the amount of tax shield that you would get for depreciation. So again, it looks complex on this slide, but trust me, it gets relatively easy when you look at it from an example perspective. So capital budgeting project evaluations, you've got expansion projects, which are decisions on whether to add a project that's intended to increase sales, provide growth to the firm, make the business bigger. And then you've got replacement analysis, which is analyzing the decision as to whether to replace an existing still productive asset with new assets to maintain or improve existing operations. So here's an expansion project example. Let's say we've got a HEP project is what we'll call it, and these numbers are all in millions, which is what this signifies. So you add 000 at the end. This is a relatively common way that finance folks show analysis so that these numbers don't become huge and are easier to modify. So we start with a purchase price of this piece of equipment is $9.5 million. The shipping and installation is $500,000. And we need to increase our net working capital because we're going to have to buy some inventory. We're going to have to, so raw material inventory to build the thing out. We're going to have some money set aside to pay wages while we collect accounts receivable, et cetera. So we're going to need to set aside $4 million to buy the initial inventory and do and have a cash reserve. We expect that this project or this project is going to have a life of 4 years. And at the end of 4 years, we're going to sell it for $2 million. So the reason these are negative is because this is cash going out. We're going to have to pay $9.5 million plus $500,000 to get it installed. So that's $10 million in total to get it up and running. We're going to have to put $4 million in inventory. So we set that aside. And then 4 years, we're going to operate. At the end of 4 years, we're going to get our salvage value of $2 million. So let's say this is a product expansion or a new plant. We're going to sell it for $2 million. Over that period of time, we're going to have an increase in sales of net sales of $30 million. We've got a variable cost ratio of 60%. We've got a fixed cost increase, excluding depreciation, of $5 million. We've got a marginal tax rate of 40%, and we've got a depreciation method, and we use the tax depreciation method, not the depreciation method for book. We use tax because we're trying to determine what the actual tax shield is of 5 years, 5-year makers, which is modified accelerated cost recovery system. And that's a tax provision methodology that the IRS allows you to use to accelerate your depreciation recovery. So we take a look at how much cash do we have to go out on the initial investment outlay. When we look back at the project and we kind of allocate each one of these cash flows, we say, okay, purchase price is $9.5 million, shipping and installation $500,000, and increase in net working capital $4 million. So in period zero, in order to even undertake this project, we're going to have to lay out $14 million. Then we take a look at the change in net operating cash flow, and we say, okay, the net sales, change in net sales is an increase of $30 million. We had a variable cost, and that's essentially going to be, if you think about it from a manufacturing perspective, that may be your cost of raw materials, your cost of manufacturing labor, anything that's going to be put into the inventory to manufacture the project or to manufacture the product. And that's 60% of sales. And so again, that was given to us in the assumptions. So we multiply 30 million times 60%, we get $18 million. That's our cost of sales. And then we had the increase in fixed cost, excluding depreciation, of $5 million. So our change in operating cash flow before depreciation and taxes was plus $7 million. So let's assume that this started January 1st, 2020, and we have and this is the depreciation analysis. So we had a $10 million worth of depreciation. Now, where did we get the $10 million? It was the $9.5 million of new equipment plus the $500,000 of installation. From a tax perspective, and generally when you're looking at even GAAP accounting, the cost of installation, shipping and installation, needs to be added to the basis of the equipment in order to determine depreciation. You can't expense that for tax purposes in the period in which it's incurred. And so you've got a depreciable basis of $10 million. Makers, and you can Google makers. There's also in your book, there's makers tables. But makers, 5-year makers, has, instead of going 20% each year for 5 years, it actually has a accelerated depreciation where it gives you more depreciation in the first 2 years and then slows down a little bit over time. And so in 2020, you've got a maker's rate of 20%. So you get to take $2 million of depreciation in year 1. In year 2, you've got a maker's rate of 32%. And so you get to take $3.2 million of depreciation in year 2. In 2022, 19%. So it's $1.9 million in year 3. And in 2023, you have 12%. So you've got $1.2 million of depreciation in year 4 in 2023. So when you add these together, your accumulated depreciation is $8.3 million at the end of the project life. So this is going to be important because you have a depreciable basis. You have a $10 million project. At the end of the useful life of the project, you've depreciated $8.3 million. So on the books and for tax purposes, this project has a basis left, a basis of 10 million minus 8.3 million, so $1.7 million. So you can see how we came up with the depreciable basis there. So when we look at the operating cash flow analysis, the supplemental operating cash flow is equal to the net operating income plus depreciation times 1 minus the tax rate plus the tax rate times depreciation. So we analyzed the cash flow. If we look back a couple slides, we analyzed the cash flow and came up with the $7 million. We didn't include depreciation here, so you can kind of set this aside. And we multiply that by 1 minus the tax rate. So we get to keep 60% of that net operating cash flow amount. So, because 40% needs to be paid in taxes. So we do that, and then we add back the depreciation amount. So again, when you take a look at this is non-cash expense, so it's money that essentially is what we call a tax shield. So we don't have to pay taxes on this $2 million of depreciation in year 1, and this $3.2 million of depreciation in year 2, and a $1.9 million depreciation in year 3, and a $1.2 million depreciation in year 4. So we multiply that by 0.4, and we add this together, and so our operating cash flow, after tax operating cash flow, in year 1 is $5 million, in year 2 is $5.48 million, and again, you can see that that went up because, well, this is the same and this is the same. You had a tax shield associated with that accelerated depreciation, and then $4.96 million in year 3 and $4.68 million in year 4. And again, the reasons these are declining is because your depreciation is going down, and so you have less of a tax shield. The $7 million excludes depreciation, thus depreciation should not be added back. And again, I mentioned that at the top, but you can see that note here. So the selling price of the asset, here's our terminal cash flows. Our selling price of the asset at 2023 was $2 million, and that was given to us in the assumptions at the beginning. We have to pay tax on that asset of $120,000. Now, where do we get that? Let's look down here. We had a gain on sale of $300,000. So we have a sale that was given to us at $2 million. That's our assumption. We had a book value. Remember, we calculated the depreciation, and it was $10 million minus $8.3 million of accumulated depreciation right here. Gives us $1.7 million of book value. So we had $300,000 of taxable gain. If we have something on the books for $1.7 million and we sell it for $2 million, you have a gain of $300,000. The IRS is going to get their piece. So what piece do they get? Well, we saw in the assumptions that we had a 40% tax rate. And so the $300,000 of gain we get here, we multiply that by 0.4, and we have to pay $120,000 in taxes. So when we go back to our terminal cash flow, we get $2 million. So somebody hands us a check for $2 million to buy HEP. But we still had a basis in HEP of $1.7 million. So we recognize a gain of $300,000. Now, for accounting purposes, you go, well, I have a gain. For finance purposes, you have $2 million of inbound cash, but you have to pay outbound cash of $120,000 associated with the taxes. The other thing we get back is that $4 million in net working capital. So we've stopped accumulating inventory, and we sold our inventory off, or we used it for our final manufacturing. We collect our accounts receivable. So we get that $4 million that we had to put out in period 0 back in period 4, at the end of period 4. So our terminal cash flow is $5.88 million. $2 million for the sale price, $4 million for the return of working capital, minus the $120,000 that we have to pay in taxes on the gain associated with the sale of HEP. And this is how it looks like in a capital budgeting table. I find these tables to be extremely useful and helpful to keep things both lined up in terms of how to discount the cash flows. And in Excel, this is really, really, really easy. So I would recommend when you're using Excel to do your homework or using Excel for the test, utilize this layout, it's going to make life really easy for you. You can analyze things very quickly. You can sum columns really easily. And an NPV formula or IRR formula or MIRR formula works extremely well and very easily utilizing this format. So I highly encourage you to use this format. Here's the cash flow. So you've got your initial investment outlay, your supplemental operating cash flows, terminal cash flows. Those are the three categories. You're always going to see those three categories. Make sure you keep those three categories separate and analyze each of those three categories. We go back to the analysis we just did, and we said, okay, initial investment outlay was $14 million. That goes in as a negative because that's money out in 2019. So bang, here we go. 2020, we had $5 million of supplemental operating cash flows. That comes out here. And again, we go back to our supplemental operating cash flow table and just set that in here. 5.48 million in year 2, 4.96 million in year 3, and 4.68 million in year 4. Plus, we have the terminal cash flows in the final year of 5.88 million. So you add that together. So our net cash flows are in period 0. We had $14 million go out. Period 1, we had $5 million come in. Period 2, we had $5.48 million come in. Period 3, we had $4.96 million come in. And at the end of the project life, we had $10.56 million come in. So the question that we have to ask ourselves is this a good thing or not? And the answer is it depends. And what does it depend on? Well, it depends on what our required rate of return is on these cash flows, because if we're putting $14 million out, and we know that that's coming out, we're getting this money back over time. And remember, money today is worth more than money tomorrow. And so, well, you go, well, geez, that makes, I'm looking at this thing and it's, 10 million, just back of the envelope, 10 million, there's 20 million. There's $25 million about, and we got to pay $14 million to get that. So, that's $11 million of profit. I want to do that all day long. Well, it depends. It depends on what the discount rate is, how risky the project is, and how solid these cash flow estimates are. So how do we do that? Well, we utilize the risk analysis associated with the time value of money, which is the required rate of return. And we just discussed that in the last couple chapters. So let's dig into that. For this particular project, and you've seen that we've used 10%, over a course of time. For this particular project, and you'll start to analyze this in terms of projects, the required rate of return on this project is 15%. And so we start doing the discounted cash flow analysis. So we do a net present value analysis of essentially the cash flow stream that you saw up there, or that you saw on the last slide. And again, Excel, it's a formula equals NPV. And then just drag it right along that cash flow line, and it'll calculate it for you based upon your required rate of return, which you'll enter into that formula. So we start with $14 million out in period 0. We discount the cash flow at the end of period 1. So that $5 million in period 1 cash flow discounts to $4.348 million. Then we discount the period 2 cash flow, which comes to $4.114 million. We discount the cash flow for period 3, which comes to $3.261 million, and we discount the period 4 cash flows of $10.56 million. That discounts down to $6.038 million. So the NPV on this, you said, well, I've got $11 million of profit. Yeah, that $11 million of profit is actually only worth to you $3.8 million roughly today. However, it's got a positive net present value, which means we should undertake the project. The internal rate of return on the project is 26.3%. Our required rate of return is 15%, so that's an indication we should do the project. Payback period is 2.7 years. The discounted payback period is 3.4 years. We know it's a 4-year project. This is before the 4-year point, so that's an indication that we should do the project. So it looks like, by all indications, if our cash flow estimates are accurate, and we factored the potential for inaccuracy and volatility, the risk associated with the project into the rate of return, that this project is one that we would want to undertake. So let's take a look at a replacement example. And a replacement example might look like this. We've got an old lathe and that old lathe is sitting in our factory. We paid $7.9 million for it many years ago. It's got 5 years life remaining. Its salvage value in 5 years is $500,000. Its salvage value today, so if we sell it today, it's worth $1.6 million. We don't need to do any net increase in working capital. It's just kind of cranking along, doing what it's doing. And depreciation method, we've got $500 worth of depreciation left on the lathe. We go to this new machine, so we decide, hey, we're going to replace that old lathe with a new machine. The new machine is way more powerful. It's much more efficient. So if we do that, we're going to have some changes to our existing cash flow. So let's take a look at what that means. Well, the new machine is going to cost us $9.5 million to buy. It's going to last us 5 years because it's super cool and high tech, but its technology will wear out in 5 years. Its salvage value in 5 years will be $2 million. It doesn't have salvage value today, so here's the old lathe versus new lathe. It's going to decrease our operating costs because it's so wickedly efficient by $3.5 million. So our operating costs are going to come down by $3.5 million, which means we're going to see $3.5 million of additional operating income. We're going to have to, because this thing's so efficient, we're going to have to increase our inventory on hand. And so that's going to cost us an additional $1.4 million to buy the additional inventory to keep the line moving. Our marginal tax rate is 40%, and we're going to use 3-year makers, which again, look in the book. You're going to be able to see the makers tables, or you can look it up online. We've got 3-year makers on this asset. So should we keep the old lathe and just crank along for the next 5 years, not spend the $9.5 million, or do we spend the $9.5 million and get the new wickedly efficient lathe for the next 5 years, and which is a better choice? So this is a classic replacement analysis problem, and we're going to walk through the capital budgeting analysis for it. So on the replacement analysis, the first thing we have to look at is what would be the initial cash flows if we sell the old lathe today. So the old lathe, we say, okay, we're going to get the new lathe, so we're going to sell the old one. So if we sell the old one today, we're going to get $1.6 million. We've got tax on sale of assets. So if we take a look at the other one, it was $500 straight line asset. It was $7.9 million to purchase. So we look at, okay, how much accumulated depreciation have we picked up? Well, in this particular case, $7.9 million. It's 10-year-old lathe. So we've got $5 million of accumulated depreciation. We've got a book value, $2.9 million left. So we've got a gain on sale. We got to calculate the gain on sale. The sale price would be $1.6 million. That was given. The book value is $2.9 million. That's calculated here. And I apologize, did not give you the 10 years that it's already 10 years old. So the book value is $2.9 million. So we'd have a $1.3 million loss associated with the sale of that lathe. We have a sale price of $1.6 million. The book value is $2.9. So when we sell it for $1.6, we have a $1.3 million loss. So the tax on gain, you have a loss, $1.3 million at 40%. So we actually have a tax shield. We get a tax refund back from the federal government and state government of $520,000. So we would not only get the $1.6 million associated with the sale of that asset, but we'd also get a deduction on our taxes of $1.3 million associated with the loss, which results in improved cash flow of $520,000. So we add these two together, we get $2.12 million cash from selling the old lathe today. You can see a negative tax represents a refund, which is cash in. So let's look at the cash initial investment outlay for the new machine. So we would purchase a new machine for $12 million. We have to increase net working capital of 1.4 million, but some of that is offset by the fact that we sold the old lathe and we got cash from that plus the tax refund. And so our initial investment outlay is going to be the purchase price plus the increase in net working capital to get the additional inventory and such, minus the cash flow from selling the old lathe. So our initial investment outlay is $11,280,000. When we're looking at supplemental operating cash flows, and this is almost always the case associated with replacement analysis, the change is the most important component. So you're going to have an existing asset which is doing existing things, and then you get a new asset to replace it. We're only looking at the change because that's the difference in what the cash flow is going to be, not the absolute cash flow. And so you could tend to get tripped up on problems on both test quizzes and in real life around forgetting that it's just the change. So when you see replacement, immediately think change. What's the change in cash flows? Because I'm replacing something with another, not just the ultimate total cash flow. So let's take a look at the change in depreciation. Old depreciation was depreciating at $500 a year. We had 5 years left to depreciate it. And a new machine's depreciable basis is $12 million, and it's on a 3-year makers, and 3 years makers, and again, I know this is confusing, 3-year makers means that it's depreciated over 4 years. So you have a half-year convention at the first year and the last year. Again, don't worry about the tax piece of this. When you take the tax class, you can get into that, why makers is structured that way. What's important is when you see that something is on a specific depreciation schedule, 3-year makers, 7-year makers, 5-year makers, 30-year straight line, 27.5-year straight line, 27.5-year makers, that you look up the table and utilize the table and make sure you got the percentages right. So in this particular case, the new machine depreciation is going to be 12 million times 0.33 because that's the allowable depreciation for first year on 3-year makers. So that's 3.96 million. 0.45, 45% of 12 million is 5.4 million. 15% of 12 million is 1.8 million. And then you've got the residual depreciation in the final year. So 12 million times 7% gives you 840. So when you add 339.60 plus 5,400 plus 1,800 plus 840, that's going to give you 12,000 or 12 million since the amount is in millions. And so it fully depreciates in 4 years. The old machine depreciates $500,000 a year. So 500,000, 500,000, 500,000, 500,000, 500,000. So you're going to subtract this minus this is going to give you 3,460. This minus this, 4,900. This minus this, 1,300. This minus this, 340. And this, 0, because you're fully depreciated on makers. But you still had depreciation on the old machine of $500 left in the 5th year. $500 negative. So in the final year, you actually would have more depreciation under the old machine than you have in a new machine, but you have a lot more depreciation on a new machine than the old machine change over that period of time. And remember, depreciation is a non-cash expense, but it serves as a operating cash flow because it's a tax shield. So let's take a look at what that operating cash flow looks like. In 2020, you have $3.5 million in additional operating cash flow, which is from the savings, but you have to pay tax on that savings because it's additional operating income, and so you have to pay your 40% tax on that. But you get back 40% tax shield on the depreciation expense. So in 2020, you save $3.5 million in operating expense, minus the taxes you have to pay, and you get back a refund, or you shield taxes of $3.46 million. So you get $3,484,000 in year 1. In year 2, your supplemental operating cash flows are $4,060,000. In year 3, your operating cash flows are $2,620,000. In year 4, $2,236,000. Year 5, $1,900,000. Those are your supplemental operating cash flows associated with undertaking this investment. So you've got some assumptions around the replacement. So if HEP buys a new machine, the old lathe will get sold today. So you go ahead and sell it, and we put that in the initial cash flow piece. If HEP sells the old lathe today, the company will not be able to sell it for its $400,000 salvage value in 2024, which means HEP will not receive $400,000 in 2024. This is a relevant cash flow. You have to factor this in because it's an opportunity cost. Because a loss of the $400,000 salvage value, which results from the decision to purchase a new machine, is something we have to consider. Because if we didn't purchase a new machine, we wouldn't have outlaid all that stuff in year one, and we wouldn't have gotten the cash flow in year one for this machine. But we also would have gotten cash flow from this machine in 2024. So that $400,000 should be recognized as a cash outflow in 2024. So let's take a look at what that looks like. The book value of the new machine in 2024 is zero because it's fully depreciated, but we're going to get $2 million by selling it. And so we know we've got $2 million of cash coming in. There's a zero basis, and so we've got a gain of $2 million. The tax on the sale of that new machine is $2 million times 0.4, so $800,000 we have to pay in gain. So the net cash flow from the sale of the new machine at the end of its useful life is the $2 million that we get for it, minus the $800,000 of tax we need to pay on the gain. So we net $1.2 million in 2024 associated with the new machine. The other thing that we don't get is the $400,000 salvage value from the old lathe. So we have to factor that in. So we have the $400,000 salvage value from the old lathe that we didn't get. So we get the $1.2 million from the new lathe. We don't get the $400,000 from the old one that was factored in. We get a return on net working capital of $1.4 million. So remember, we had to invest in additional assets in order to be able to, whether that was accounts receivable or inventory, we get that cash back. So we get $2.2 million in the final period associated with the sale of the new machine, and the return of net working capital minus the amount of the money we would have gotten on the new lathe had we not sold it in period zero. So, question, is this a good project to do or not? Well, let's take a look at the cash flows. We have $11.28 million going out in initial cash flow, 3.484, 4.060, 2.620, 2.236, and $1.9 million in supplemental operating cash flows. And you can see that from a couple slides back. And then our terminal cash flow is $2.2 million. So our net cash flow, again, I strongly recommend you lay these out in a table format like this. You've got $11.28 million going out, and you've got your supplemental cash flows going in. And so you say, okay, let me just back of the envelope this thing, $3.5 million, $2.5 million, $6 million, $10 million, $14 million, 14, 15, 16, 16.3, 16.4 million total cash, 11.28 million going out. This is profitable for $500,000, at $5 million over this 5-year life. This should be something we do, because it's $5 million profit. Well, not necessarily. So it depends. Again, what does it depend on? It depends on the rate of return associated with the risk of the project and the required rate of return, and the timing of the cash flows. So let's take a look. Do you do this or not? Well, if we have a required rate of return of 15% and we lay this out, we've got our initial outlay is $11.28 million, then we get $3.5 million coming in. Discount that's 30/30. You got 440/60 in 2021. Discount that's 30/70. You got 26/20 out here. Discount that's 17/23. You got 22/36 out here. Discount that's 12/78. And you got 4100 out here, 5 years out. That's 20/38. So you can see with a discount of 15%, once you get out 5 years, you're cutting the present value of that amount in half. Actually, more than in half. And so what's the value of this today? Well, the net present value of this is negative $141. So you wouldn't proceed with this project. the internal rate of return is 14.46%, which is less than 15%, which is an indication, again, it's not a modified internal rate of return, so it's not discounted, but it's an indication that you would not proceed with this project. Payback period is 3.5 years, so you might go, oh, that's great, I get my money back, and you can see that, that occurs in here, but the discounted payback period never happens. It's greater than the 5-year point, and so all indications are that, hey, we are not going to do this project, even though when you look at it from an accounting perspective and you just use raw numbers without discounting, it says that this project is a great project. We're going to make $5 million additional dollars over the next 5 years if we proceed. $5 million on this project is not enough to proceed with it because of the timing of the cash flow. The risk is too high, and that's driven by this amount here. So again, taking that step back to everything we've learned to this point, think about it this way. You look at cash flows. Cash flows today are worth more than cash flows tomorrow. And how much more? Well, that's determined by how risky those cash flows are. And how do we determine what the risk of those cash flows are? It's driven by the required rate of return, by the percentage that you're going to get. And a higher percentage you think you're going to get on any asset, the riskier it is, all things being equal. And so we talked about this a little bit. I'm going to dive into it a little bit more. Project risk should be evaluated to determine what the appropriate rate of return is to compute the project's net present value or compare it to its IRR. If a firm's considering a project that's much riskier than existing assets, then it makes sense for the firm to expect a higher rate of return on that project than on existing assets. So you need to look at the risk associated with a project, not just the risk associated with the firm, because if you use the firm's required rate of return as a whole, and then you put a very risky asset on it, you're going to do those risky assets all day long, but that's going to impact the overall risk of the firm. You need to look at the project as a standalone as opposed to just looking at it from the perspective of the firm. So standalone risk is risk of the asset held in isolation, that is when it stood alone. Corporate or within firm risk is how the asset affects the firm's total risk if it's purchased and added to an existing asset. Essentially, start thinking of the corporation as a portfolio, and we talked about diversification. You can put additional stocks in your portfolio, and that's going to decrease you could have multiple betas, and those betas kind of combine to reduce risk and give you a market type analysis based upon diversification. You can do the same thing with projects in a corporation, but remember, there's risk associated with how that sits within a firm, and then there's also how the market perceives that. So how does the asset affect the firm's market risk or beta if it's purchased and added to an existing asset? In general, investors like to invest in a company that does one or two things really well and will diversify with other companies. What investors don't necessarily like is a company that decides to mirror the market and become identical to the market by investing in all sorts of different things. So you don't necessarily want Amazon, and again, I'm using this example because it's relevant, to invest in grocery stores or to invest in cloud computing or to invest in hardware or to invest in e-commerce or to invest in consulting or to invest in and have projects around all those things because they're essentially starting to mirror the market. You probably want a company that's really good at each one of those elements, and then you combine it to get best of breed to give yourself essentially a market type portfolio for your investments. The same thing happens here. So investors will look at companies and tend to look at what is that assembly of projects or those assembly of businesses within the corporation look like and assign market risk to it. And when that changes, the market risk changes. So a couple techniques for measuring standalone risk. You can look at it from a standard deviation perspective. So you've got key variables are changed, the resulting changes in an NPV and IRR are observed. So if you say, hey, it's a 10% off from the existing base case, here's what happens to the company as far as NPV goes. So if you say, hey, if I assume that these set of cash flows are 10% lower, 10% higher, what happens to NPV, what happens to the expenses, to the savings, what happens to the required rate of return, and what happens to the change in required rate of return. So this will show the sensitivity around what happens if you're wrong, essentially, if you've had an impact here on the overall value of the firm. So you may say, okay, our best case scenario is going to be $10,000 of savings. The net present value on that, based upon the analysis that we did, was, 3.953 million, but there's only a 20% probability of that occurring. And so the net present value times the probability is $790.60. The base case of what we expect to happen, $800,000, $308 NPV, 70% chance that happens. That gives us this. However, we could see only $600,000 worth of savings. And so that would give us a negative NPV of 3.337 million. And there's a 10% chance of that happening. So that gives us a negative NPV of 333,000 or 333.70. We add these together and we get an expected NPV of 672.50. We calculate the standard deviation of NPV, and that's 1,962.89, and a coefficient of variation is 2.92. And so you would take a look at the coefficient of variation based upon this project's NPV and take a look at the average risk project for an NPV and go, yeah, it might look great at the base case, but when we take a look at the probabilities of best case and worst case, and maybe this worst case was 30% probability, and this was 10% probability, and this was 60% probability, at that point you wouldn't do this project because your expected NPV would be negative and it would be a very risky project. And so again, those are things that you would want to look at as the probability of this thing going bad. There's a few techniques that you can use to measure standalone risk analysis. Monte Carlo simulation is something that you generally will be using software to do, and we're not going to do it in this class. But it's a simulation where you essentially run through all possible outcomes, all the situations, all the variables, you tweak them, you assign probabilities to all of them, and then you run test after test after test after test and come up with a essentially universe of probabilities associated with the various variables, and then you run analysis against that and you come up with a capital budgeting project that has almost an infinite number of each of those variables changing and an infinite number of net present values. You sum those together and you determine what the volatility of that is, coefficient of variation, as well as what the expected net present value is. When we're looking at the risk within a firm, you determine how capital budgeting is related to existing assets. If the firm wants to diversify its risk, it tries to invest in projects that are negatively correlated or negatively related to its existing assets. If a firm can reduce its overall risk, then it generally becomes less risky and its required rate of return decreases. When we look at the market, you've got any asset has a beta or some way to measure its systematic risk in theory. So the capital asset pricing model should hold for almost any decision. If we can determine the beta of that asset, then we can use capital asset pricing model to compute its required rate of return as follows. Now again, the concepts here, whether you can calculate beta or not, are almost irrelevant. It's understanding the concept that's important and how it's utilized. And so again, the risk of a project is equal to the risk-free rate plus the risk premium for the project times the volatility of the project. And so again, we're looking at the concept of, in order for you to determine what your required rate of return is, you need to factor in the risk associated with the project plus the risk-free rate. Measuring beta for a project risk is difficult because you generally don't have a bunch of history around product volatility and product expectation variation. And so the easiest way to do that is a pure play method where you find publicly traded companies where their only business is in that project. So it may be, when we were talking about Amazon, it may be you've got a company that only sells things like Whole Foods, so Sprouts Market maybe, and you go, okay, what's a beta been on Sprout Market? Okay, fine. We can assign that beta to as a proxy to the Whole Foods investment or Whole Foods was a publicly traded company, so Amazon was able to analyze beta based upon Whole Foods. When we look at the required rate of return for a project, the calculation is very similar to what we saw in the stock side. So if we've got a capital budgeting, the cost is $100,000. The beta for the project is 1.5. The risk-free rate is 3. The market rate of return is 9%. The required rate of return on the project is the risk-free rate plus the market premium, which is 9 minus the risk-free rate times 1.5. So order of operations, we've got 6 times 1.5 is 9, plus 3 is 12. So the firm's characteristics before purchasing the project, so the firm had total assets of $400,000 and it had a beta of 1. So the firm's beta after doing the project, we start with $400,000 assets. We add $100,000 of assets. That gives us $500,000. So we took the original firm plus the $100,000. That was, so 80% of the firm is still at the 1x beta. And then you've got 20% of the firm is at the 1.5x beta. You add these together and you essentially just get a weighted average of the betas based upon the total asset amount of 1.1. Capital budgeting decisions are analyzed based upon risk. And so most firms use a risk-adjusted discount rate, which is equal to the risk-free rate of interest plus a risk premium. Again, you're starting or should be seeing a common theme around finance when we're looking at risk, that it's driven by this required rate of return concept. The average required rate of return is adjusted for projects with above average or below average risk. For example, if you've got a company and you say, okay, I'm going to bucket every project we get into a high risk, an average risk, and a low risk category. If our required rate of return for the business is 12 and that is our average risk, maybe we have a 4% risk premium associated with above average risk, and we have a 2% risk discount associated with below average risk. And so we utilize these required rates of return within the firm to analyze our capital budgeting decisions. When we're looking internationally, you've got some other elements that need to be factored in. For the most part, when you're looking at an international project, your capital budgeting projects for multinational firms or for international projects are going to be evaluated the same, but a couple things to remember and to factor in which add to the concern. The first one is reparation of cash might be restricted, so sometimes you might not be able to get the cash back for a long time, or you might have double taxation, so you might have to pay tax in the foreign entity, and then when you bring it back into the United States, you got to pay tax again. And so that may limit your cash transfers or cash availability and might require you to maintain higher levels of working capital, so keep that in mind. The other piece is projects associated with foreign operations are generally riskier than domestic projects. Exchange rate risk, so you've got the risk associated with changing currency. So if you've got a project and you're conducting that project in South Africa, you're going to be exposed to changes in interest rate or changes in currency exchange rate between the South African rand and the US dollar, in addition to the risk associated with operations risk and just normal interest rate risk and risk-free rate, et cetera, because you're going to have to translate all the money you make in South Africa from rand back into dollar and repatriate that money in order to have it available for use here for your investors. And then political risk. Government might expropriate or restrict operations of a foreign subsidiary in its country. We saw this, haven't seen it as much of late, but we've seen this, for instance, in Venezuela. Back in the 80s and 90s, they nationalized all the oil companies. And so the oil companies used to be owned by, Atlantic Richfield and British Petroleum, and the Venezuelans came and nationalized those. And so as a result, those were expropriated and it impacted those firms' returns. So you have political risk associated with that. The United States, for all of its faults, tends to have very strong property rights and tends to be very stable with respect to political risk. Other countries less so, and so that needs to be factored in as well. And how you factor that in is going to be essentially looking at the required rate of return. The required rate of return is your measurement of risk. I know this was a really long chapter, but it's, again, kind of pulling a lot of these concepts together and working through it. There's a lot of projects that you'll be utilizing both in the real world and here in class. I find this to be one of the most fascinating, fun parts of finance because you're pulling all the stuff together. You're looking at it as a business. You're analyzing each of the business components. You're putting cash flows against it. And you're trying to figure out whether to proceed or not proceed with something. This is really where the rubber meets the road in finance from a decision-making perspective.